Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, and welcome. Second hour of the Investor Coaching Show. I'm Paul Winkler. I'm Evan Barnard and Dan Hill. Talking money and investing, the world of finance. There's a lot of stuff to talk about and a lot of stuff we'll get into in this hour as well, as far as what's going on, what our investors are doing, the data on, there's some interesting data we'll talk about this hour as well. How are things guys going? Any interesting things you guys run into that, out in the world of high finance?
Yeah, it's interesting. People are the same the world over,
Sure.
right? Let me start there.
Yeah.
And, so guy up in Tullahoma, actually.
Uh-huh.
And, going through initial meeting and, brings in a statement and it's put together by this investment professional. So it wasn't something he built. Like, okay, because it's always nice not to have to beat up on the person that actually built the portfolio. But, here's this mix. And so we're in Tennessee, a lot of muni bonds and several equity holdings. Fine.
Munis.
Yeah. In a non-qualified account. And
National or?
national what?
Yeah, national municipalities, or is it all local Tennessee municipalities? Or I'm just curious.
No, just all over.
Oh, okay.
Yeah.
Well, see, that makes even less
When
sense.
you're saying national, I was like, we don't have any national municipal bonds. That's what threw me.
Right. Well, yeah, hopefully not. Well, the
Those are
point
treasuries.
I'm making right here, folks, that you don't know, when you're dealing with municipalities, you're dealing with an entity that's borrowing money, and because it is a municipality, somebody that buys those bonds doesn't have to pay taxes on it. And you think, hey, great, I can get away from taxes. But if you don't have a state income tax, you got less of a benefit really going on there, number one. Number two, you have a lower yield for the risk taken is the problem that you're dealing with municipals. And a lot of times they just don't make a whole lot of sense. And it's even hard pressed to make sense for a super, super high tax bracket person because of the difference in the yields on them. But anyway.
If you're paying no tax on a not credit return, below average return.
Yeah.
Versus tax on a really high return, great.
And the risk in the issue, because
Default,
the reason we own bonds is we want to make sure that we own something that we don't have to worry about if the stock market goes down, that they default or anything like that. And you haven't gotten away from that risk. You're taking that full on, and we want to make sure that we have things that move in dissimilar fashion. And the types of bonds that tend to move in the dissimilar fashion with the stock market are not necessarily municipalities. But anyway, I just want to make sure that was clear to people that are out there.
So that that jumped off because I don't run into those very often, to be honest. Any of the offices.
Yeah.
And but several equity holdings, and so put them in Morningstar, went through stuff, and basically all 7 equity holdings held Microsoft, all 7 equity holdings held NVIDIA. They all held Visa. They all held United Health. And so you have this
no diversification,
quote unquote, professionally built portfolio that just is, I won't say garbage. It's not diversified.
No, go ahead.
I'll go with not diversified.
I'll clear that.
Yeah, and so that persists. The interesting thing in terms of this actually happened, met some people in Murfreesboro, just the concept of revisiting what's going on in your situation. Is this strategy, does this risk-return mix still support what I'm going to do, as well as just the administrative stuff that goes on. Hey, when was the last time you updated your beneficiaries? Hey, and
QCDs. I run into that all the time.
Qualified charitable, so offering those. Here's been the interesting thing, and this has probably been in any of the offices. I've had a few questions recently around from people that, with all the education, with all the workshops that are out there, ads on talk radio and so forth, weren't aware that they got a spousal benefit, from their partner, and Social Security. I mean, just some real basic things, and it's not their fault. I mean, they're not a financial advisor, but it reminded me of really how valuable we are well beyond rebalancing a portfolio and structuring an evidence-based account is.
Yeah. And a new tax law.
There's a lot of those things.
You know, adding complexity to people's lives.
Yeah.
Yeah, and helping people wade through all of that. How do you use this to your benefit? Sure.
Yeah. And those are fun appointments of, well, yeah, we just found you another $1,700 a month income.
Oh,
really?
yeah. Yeah, no, I think that's a point well taken. A lot of times I'll have meetings with people, on a regular basis. Come on in. And we do that all the time, in all of our offices. Get in there, have a meeting. And I had a lady showed up the other day and brought her kids, her daughter and son-in-law, and they sat there with Mom. And the thing that happened, what I thought was really interesting, I said, so what do you want to talk about? She goes, I don't know. You guys called this meeting. And I said, okay, I have stuff I'll talk about because I want to know what's on your mind. But when I brought up a couple of planning points, QCDs was one of them. She needs to start that. She didn't even know to start that. And I said, yeah, we got to make sure that we start paying attention to these types of things. And she didn't know what she didn't know. And she found out in a big hurry why she was in there, is my point.
Yeah.
Because she didn't know why she was there. And when we got into the planning aspect of things, I wouldn't have even known to ask about that. Another situation that I ran into is trust work, whether somebody needed a trust or not. We're not attorneys, but we sure have an opinion regarding people's situations, whether they ought to consult an attorney and bring somebody in for that. Sometimes I hear people say, yep, you always use one. And no, not necessarily. We got an attorney that I did a pre-record for a show that'll probably upcoming soon. I'll play that for you. But we have actually a trust attorney or an estate planning attorney talking about how often you really don't need this. But yet you'll hear financial people and you hear attorneys say, oh, you always have to have one. In some states, yeah, I agree with that. But when do you need one? When do you not need one? When you're setting up beneficiaries, how do you set up the beneficiary designations, for your IRAs? If you have an estate that is a lot of non-qualified assets and qualified assets, it may be, and if you've got charitable tendencies you want to give to charities, there may be certain assets that are better to give to charities than other assets. Just because of the way required distributions have been changed over the years regarding inherited IRAs. So there are a lot of things that I think absolutely we want to make sure that we're looking at.
Yeah, so I want to add that, all through the first hours you were playing commercials and listening to these guys. All I'm thinking about is planning, because we do, first and foremost, comprehensive planning for people to see what's right for them, before we allocate a portfolio or recommend a strategy. So I also had one of the things I always talk about with folks, when we're doing our classes and whatnot, is I always try to retire you yesterday. Just so going to work tomorrow will be more fun. And so we had a couple come over into our Murfreesboro office, and she actually got retired by Elon. She worked at the VA hospital for
'I've had a few of those.
43 years.
Yes.
And she's happy. And, so.
Yeah, they got doged. That's what they called it.
Yeah. But, so I'm doing, helping her out. And her husband was planning on retiring, I think, at 65. And so, with that beautiful software that Evan taught me, or e-money software, 15 years ago. I love it. So
which one? We use so many software programs.
I know.
Was it e-money or is it? Yeah,
e-money.
Okay.
Well, it's the one I'm primarily using. We've got a lot of them. That's why I tell people we have like 10.
Yeah, we have tax software, tax income programs, how to take income, orders of income for various assets and things like that. So when we say software, we're software hounds.
It's kind of like they don't know what they don't know, and I was able to show them like the base plan, and then what if you did not work? Like she's done, right? To whenever, what is it? September, October 1, is official Doge retirement day, I think. But he can also retire. Okay. And so that's great. That's what I love about our job. Well, I'm never going to leave this job. I don't want to retire because I want to help other people retire. So that was just a great, meeting I had over in Murfreesboro just a couple of weeks ago. And so we have a lot of those. And that's what I love about our job.
Well, that's cool. Yeah, because that is something that is on people's minds right now. I saw an article today. It was in Market Watch, and it was most boomers and Gen Xers are terrified of running out of money in retirement. And even if they're already retired. And one of the things that I have been doing lately, we had an income guide that we put out, and we get a ton of downloads on that thing. If you haven't seen the commercials or heard the commercials for that, we have an income guide. You go to paulwinkler.com/retire, I think it is. Yeah.
Or income.
Or income, either one.
And what's the price on that download, Paul?
It is complimentary.
There we go.
There you go. Yeah. So no, it is. And what we do is we go through in that income guide. I have the common strategies that people use for income, dividends off of stocks, and why that doesn't make any sense. It's a really kind of it's a very salesy type of an idea. It sounds good in theory. It doesn't work real well in practice. Real estate, is a job, and a lot of people want to get out of real estate as they get older. And I talk a little bit about the problems with real estate as an income generating source. Talk about interest on CDs. Talk about target date funds and problematic and annuities in there. And I walk through why these strategies, albeit they're often used, typically run you into some significant problems. Then I get into the evidence-based research of how you take an income from an investment portfolio toward the end of it. Anyway, that's paulwinkler.com/retire or income, either one, /retire or /income. Well, one of the things that I actually am probably going to do in the future, and as an adjunct to that, is the RMDs, required minimum distributions. The formula for taking required minimum distributions is wonderful. It's one of the few things I look at the government did that I'm really in favor of, because you can't run out of money. And it's people's worry is I'm going to run out of money. You can't run out of money because you're always taking a percentage of whatever your portfolio value is. So for instance, let's say I'm 73 years old and I'm starting my required distributions. I'm going to be taking about 3.7% of my portfolio. And then the next year, I'm going to be taking, because it's going to be your joint life expectancy of a 73-year-old as if they were married to a 63-year-old. So you look at that and go, okay, what's their joint life expectancy? About 27 years. So take your account value, divide by 27, and it works out to just under 4%. Then the next year, it's going to be a 74-year-old married to a 64-year-old, and then so on and so forth, all the way up. And you don't even get up to a 10% distribution until you're in your early to mid-90s.
Yeah.
And, so you look at that and go, okay, I can't run out of money because I'm taking a percentage of whatever's there. And I actually have a whole workshop on how that would have worked over the past 25 years, just since we opened this company. But here's the idea behind that is people worry about running out of money. And that's exactly what this article was about. And a lot of people, what they do is because they're worried about running out of money, they buy in an annuity. And one of the things that I talk about is they say, hey, guaranteed, you won't run out of money, blah, blah, blah. Annuity guarantees the income. But literally what the annuity was designed to do, less than 5% of people that buy annuities actually use it for the purpose it was designed for. And it's because they recognize that they lose control when they do that, and they don't like that. So what happens here is in this article, they're talking about how people they're kind of panic-stricken. And it says pre-retirees and early retirement have one thing in common. Based on recent surveys, rising levels of anxiety about retirement. Anxiety has been peaking for people a few years away from retirement age who are worried about the paucity of savings and staying high in the first years of retirement, and fears that spending too much will cause them to run out of money. They're worried about running out of money. And they looked at the average 401k balance for Americans 55 to 64 years old. Average, $271,000. And, when we look at average is skewed up, folks. If you want to use data, if you want to use statistics, they should have used median. Because median gets rid of the skewing based on account size. When you're dealing with, people that have huge account balances, it skews the data up. But that's average is that bad. And it says research shows, however, that some retirees are overly cautious about spending money in retirement and can afford to spend a little bit more freely, but the vast majority of people just don't have enough. They said that there was a study, Morningstar did a study, and they said 45% of Americans will run out of money in retirement. That's their estimate. And you look at it, they go, well, why? Well, a lot of it comes down to the stuff we've been preaching about here forever, is they're ignoring risk. They're taking too little risk in some cases. They're putting too much money in fixed income investments, or they're over-concentrating in certain areas of the market.
Yeah, they're not factoring in inflation effectively and just not realizing what things are going to cost. And I think some of it is they're just spending more than they thought they would, not due to inflation, just, hey, I thought I'd cut back and really I never cut back. That kind of stuff when you're not working and just not paying attention.
Well, good point. I mean, they said there was 2/5 of retirees. There was a nationwide study that they actually looked at the dreams of Americans for retirement have been delayed, altered, and canceled as a result of what? Inflation. That was the thing that actually caused so much problem for them. And I would submit that it's because of bad investing as well, because a lot of people really got nailed in 2022. They maybe got out of the stock market, and when 2023 things came back, they weren't there, or they weren't there as much as they should have been because they got
or they got out during COVID, or they got out during 2008. I mean, there's been plenty of opportunities to shoot yourself in the foot if you weren't disciplined over the last 20 years.
Mm-hmm. Yeah, and a lot of people just say that there was another study, 47% of retirees that said spending money in retirement just gives them anxiety. And it's that fear of the future. It's that worry about what's going to happen in the future. And I think a lot of it comes down to you can allay anxiety, and this is where I want to hit. This is what I think is super, super important. It's like when we are anxious, what we have to do to try to get over that anxiety is face the thing that we're anxious about, number one, and then start to challenge some of the things that we're anxious about. But we challenge it by growing in knowledge. And the more that we know, what am I doing? Why am I doing it? What are the expenses? And what are the expectations? The last one is huge, having proper expectations. If I know what to expect and I understand how this thing works, we tend to fear, is the thing I like to say, we tend to fear that which we don't understand.
For sure.
And that is why we spend so much time educating investors, walking you through over 100 years of data. Go ahead, Dan.
Yeah, so, I mean, you just hit the nail on the head of my meeting just the other day. So it's a friend I've known for years, a friend of a client. And she's coming in to do her planning. Unfortunately, she just lost her mother, so she's got an inheritance, and she's coming to do her planning. And she didn't have all her homework done as we're doing the data intake and getting the cash flow analysis prepared. So she came back in with the data, and she said, well, first, as I'm texting her, she goes, hey, I can come in early at 4. I said, fine, do that. And she goes, I hate this stuff, Danny.
Yeah.
And she actually sent me a throw-up bit emoji. Or whatever you call it.
I had a lady that said the same exact thing to me the other day. I hate this stuff, but I'm forcing myself to come and see you.
But I use this stuff that we have right here. No, because you're going to see.
Relax about money.
Yeah, you're going to see once you become educated, which is what we want you to. Right. You're going to relax about the money.
Right.
And so we went through the process, and long story short, an hour later, well, one thing that we always find out for people, we're talking about how much money we're going to spend in retirement. They don't know how much money they're spending now. So, when you put all the numbers in there, at the end it goes excess cash flow. Yeah. So do you have $2,000 left over to every month? No, kind of. I just kind of live. That would make you American, like everybody else. So what do you think? Maybe 1,000? So I tweaked it. Okay, we're going to say increase expenses, decrease the excess, and look, you're still going to be okay.
Yeah.
You're still going to be, not going to run out of money. And at the end of the hour, I said, okay, now do you feel better? You feel like throwing up? No.
Yeah.
Okay. So that's the other part of the beauty of our job and doing that stuff.
Yeah.
It's, all the psychological stuff about it. And most people are.
Yeah.
Because they just have ignorance over it. They don't have the knowledge.
Well, it's so true. And when you look at, one of the things I do with older people especially is I say that, look, what we're doing, and people don't think about this. When you're younger, when you're in 20s, your 30s, your 40s, and your 50s, and you're going through life, you're working for money. Now, it's tenuous, if you think about it, that what your income is dependent upon is you being able to go to work.
Yeah.
You got one person going to work, creating that income. Now, you got disability insurance, but nobody wants to rely on that. Really.
No,
I mean, that's kind of a scary thing. If you become disabled, I hope and a lot of people don't have disability insurance. Let's just reality. Now, what happens when you get in retirement and you're investing and you have tens of thousands of companies all around the world and 40 to 50 countries around the world? Now you have millions upon millions of people working on your behalf all around the world. They're creating an income, and you're an owner of the companies that they work for. And they're working for those companies to make sure that they continue to keep going. And their whole job is to make sure that they keep their job. And that is the beauty of when you invest and you diversify like we talk about across the world, is that you have a lot of people versus just you creating that income. And I think that's a powerful concept. All right. Yeah, go ahead.
No, I tell them, like you said, when you're going down the interstate, whatever car they're driving, you own those cars.
That's right.
Wherever they're getting their gas, you own the gas station.
That's right.
You own everything but Chick-fil-A and Publix because they're not publicly traded.
And you didn't say Krispy Kreme. I mean, Dan Evans just...
They're publicly traded.
Oh, okay. Okay.
$3.08 a share.
Well, I just hate that, if we don't bring up Krispy Kreme in any talk of individual stocks, I think it's a mistake.
But that client that came in the other day, she's a real estate person.
Okay.
So I use you own all the McDonald's, you own all the Wendy's,
right?
Sure. I like cheeseburgers.
You have a
you
lot
own
of
all
exposure.
the Krispy Kremes.
You have a lot of exposure to real estate.
A lot of real estate.
Yeah, for sure. And when we look at retirement and we look at it in that particular way, it's not as scary. It really gets down to it. You're listening to the Investor Coaching Show. Paul Winkler, Evan Barnard, Dan Hill. We will be back right after this. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. Paul Winkler, Evan Barnard, Dan Hill. paulwinkler.com is the website. And, of course, I talked a little bit about that income guide. And we've had a ton of downloads for that thing. So apparently people are really responding. That, I think, is a big hit because we go through the typical myths of taking an income in retirement. Dividends, problem with dividend-paying stocks in retirement. Because you're basically telling an old person, you're a person that's in retirement to buy a whole bunch of distressed companies to take income off of it. I mean, that just doesn't make a whole lot of sense. And I talk a little bit about the problems with that. I talk about interest and the inflation issues with living off of interest on CDs and the issue with real estate and target date funds and the asset allocation with target date funds is just abysmally bad. And then annuities, of course, we often talk about that. But you can download that at paulwinkler.com/income. Check that out there on the website, and that is a complimentary. You can't say free. I don't know why. I don't know what the difference is. Attorneys say that there is a difference between complimentary and free.
They have to exert effort to click the mouse to download them.
And your dad probably said, like mine, nothing's free.
That's it. So I'm fine. Whatever. I mean, if you like complimentary, the word complimentary, but you like free, then whatever. So just back to this article real quick here. Most boomers and Gen Xers are terrified of running out of money in retirement, even if they're already retired. They were talking a little bit about healthcare expenses in retirement. And I've seen this data, like $172,000. That hasn't changed a whole lot. They think that the healthcare expenses are going to be at $172,000 in retirement. And you look at the average savings in 401ks at being, not much different from that.
270, right?
And I'm looking for the number. Doggone it, I can't find the number now.
The one you just said earlier?
Yeah.
I think it was like 270,000.
Yeah, 271. Yeah, that's it. And you look at that and go, not bad. Nice job. You know what gets me? It's funny. It was 271. This was 172. It was just switched around. It threw me. I thought it couldn't be 271 because these numbers are exactly the same number. Man, sometimes, my dyslexia gets the best of me. But so that right there is kind of scary. I mean, you look at that and the amount of money that you're going to need in retirement just for healthcare expenses alone, not just living off of that. And they talk about the safe withdrawal rates, 4% rule. A lot of the investment companies don't follow the academic research on what drew them to that number. I mean, that number came from following very specific rules. So I think people are picking up on it because they have gone through and they've seen friends that have tried to retire and then end up going back to work. Only have to go back to work because they run their portfolio down, or maybe they look at their investment portfolio and they go, I can't retire yet. So a lot of people are in that position of being a little bit nervous about that. But you can use retirement calculators. They talk about that here. I'm going to advise against that because it's garbage in, garbage out. A lot of the retirement calculators that you see use these software programs that you have out there. They'll have a rate of return, and a lot of people don't know what return to put in there, and they don't know the standard deviation to put in there. They don't know the level of risk of the portfolio. But here's the heartening part about that. There are software programs that you can use where you can take data, and if you know the data, you can actually put that in there, and you can come up with some sophisticated models on how to take income from your retirement investments, how much to take out of qualified plans, how much to take of non-qualified plans and Roth IRAs and things like that. Now, why is it, this is the point I want to make, why is it that we can look at, or that can we feel confident about the data that you put into a software program? Well, Fama, the guy that won the Nobel in 2013, what he figured out was what factors of investing drove returns. And in English, what that means is if I know how much I have exposure in various asset categories, like large U.S. companies, I know historically the return of that asset category is about 7 above inflation. I know that small cap stocks, the return is about 9. That's their cost of capital, the cost of using your money. I know that value companies, it's somewhere in the neighborhood of about 8% above inflation. Now, you notice I keep using the word above inflation. I know that international stocks have a cost of capital, and we know those numbers. Now, if I know what those numbers are, and we put that together, and we know how much we have, if 5% of my portfolio is in an asset class returning, let's say 10%, just to use a nice round number, then I know that 0.5% of my return is attributable to that asset category. 5% of the 10%. Yeah. So I can look at a portfolio and I can go, okay, I know the expected return. Now, if I know the standard deviation, I know the 2 keys. The problem with these software programs, I'm telling you, it's more complicated than they make it out to be. They oversimplify, and it can either give people a false sense of confidence, is what I found, or it can far underestimate how much income you can take in retirement. Those are the 2 things that I've seen in using some of these less sophisticated programs.
Yeah. And the other issue is when you're modeling these things, you need to make sure that reality is what's going on in retirement. Meaning, if you have this diversified thing, we have these diversified asset categories, or someone just does it on their own. Let me go there. And they may say, okay, well, I'm going to do this, and I'm going to put this much in the S&P, and this much in cash or bonds, or, a very simplified thing. Mm-hmm. And they may think, okay, I've got this portfolio, it's 60-40. Everybody says I should have 60-40.
Yeah, that's right.
But if they're not drawing down the income in the right way, or even if they start with a fully diversified portfolio, and they're taking distributions pro rata, some from each fund as opposed to fixed in, all of a sudden that math flies out the window if you don't execute what you were modeling.
Yeah, that's it. Yeah, and it's funny because Jonathan said when he worked for the bank, that's the way they taught him.
Pro rata.
Yeah, exactly. Jonathan
Yeah.
Walker that runs the Gallatin office. He actually, in Murfreesboro, he's out there as well. But yeah, he talks a lot about that. And it was just wrong. But
Right.
that's what they taught him because
Yeah.
it was a simple way of doing things. Really good point. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.